Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
The Q3 earnings season is going to be wrapping up soon. Let's see where we stand now with our research director, Shiraz Mian, who joins me here. So, bottom line, I normally ask this at the end. I'm going to ask it at the beginning this time. Bottom line, how much are the S&P 500 profits collectively on pace to rise in this quarter?
25% plus. So we had a 780-year high in the second quarter of this year. First quarter was very high as well. So Q3 is on pace to be as good as what we saw in the first half of the year. I think it's 25.2% now. When all is said and done, I would say about 25.4, 25.5, in that range.
All right, let's break it all down. Let's run down the scorecard.
So I have this slide, and 455 S&P 500 companies have reported results. That's 91% of the index's total. And what this comparison chart, side-by-side chart, show is the earnings and revenue growth. It compares for these 455 companies with what these same companies had done in the preceding quarter, the 4-quarter average and the 12-quarter average. And then we do the same for the beats. What proportion of these 455 companies are beating EPS and revenue estimates? So as you could see in the chart, earnings growth is 26.2%. Revenue growth is 8.8%. Now we're talking just about this 455 companies, not the total 500.
Yes.
And 78.5% are beating EPS estimates. 63.5% are beating revenue estimates. And as we could see on the chart, the earnings growth is about in line with what we saw in the preceding quarter. Revenue growth is a tad bit on the light side. If we come to the right side chart, EPS beats are about in line with historical levels, and revenue beats are a bit on the light side. So I have one other slide, Terry, that shows the scorecard only for revenues. And in here, we're just comparing the top line growth across periods and the revenue beats across periods. And you would see that growth is a bit on the light side relative to the preceding quarter, in line with historical periods. And the proportion of companies beating revenue estimates was notably on the weak side. In fact, it's the weakest since the fourth quarter of 2016.
So they're not beating by wider margins.
Well, the margins are bigger.
Okay.
So when they do beat, they beat by a bigger margins. But revenue beats, so earnings beats, they are bigger margins. So the surprises are bigger. Revenue beats are on the weak side.
So is that the good news in all of this? That the beats are by wider margins in some areas?
So it tells you that if there are pockets of weakness, those are specific either to those industries or those specific companies. The broader corporate sector is still in pretty good health.
All right, standout sectors.
So overall, there is breadth of growth. Across the board, of the 16 Zacks sectors, 13 are in double digits. So the growth is across the board: finance, technology, health, retail, industrials, basic materials. When I compare the actual results relative to preseason expectations, I think what really stood out was the auto sector. Even though it's a smaller sector, the expectations were very low and nobody was expecting very strong numbers from those guys, and they came out to be very good. Construction similarly came out to be very good as well. Energy sector results turned out to be a lot better than what was expected. On the weak side, I would say aerospace defense turned out to be on the weak side relative to what expectations. So overall, there's a lot of growth, a lot of breadth of growth, but some of these areas had either very positive or very negative results.
Let's talk tech here for a minute. Apple's earnings were good, but overshadowed by implications of softer demand for their iPhones. So are you seeing this scenario as far as earnings throughout the tech sector? Good, not great?
I think that's a fair comment, yes. So Apple, they threw a curved ball in their earnings release when they announced that going forward they will not be sharing the unit sales data, how many iPhones and Macs and all the other cool stuff they sell. We wouldn't know the numbers.
Right.
A couple of other major tech companies appear to be struggling on the top lines too. Amazon didn't have that impressive numbers. Google, Facebook is kind of dealing with its own issues. A number of these semiconductor companies across the board said underwhelming stuff about Q4 and beyond. So I think if we generalize from these results, there is some question about global growth. There is some question about capital spending. You would recall that at the time of the tax cuts, there was this big expectation that capital expenditures will rise in a meaningful way. It has been rising, but not as much as many companies were expecting. And then with a number of these newer industries and companies, the social media and all of that, they're dealing with additional new incremental expenses on privacy, on compliance, regulation, and all that kind of stuff. So the sum total of that is that, yes, I have a slide to share that with you.
Okay.
You had very succinctly called it good but not great.
Right.
I probably don't need to show the slide because you have presented an excellent way of showing that same numbers. But Q3 earnings for the sector, 27.7% up year over year, 13.2% year over year growth in revenues. This is weaker than we have seen from tech sector in Q2 18, also the 4-quarter average. The proportion of tech companies beating EPS estimates is about in line with historical levels, but revenue beats are tracking below historical periods for tech as it is in the broader space. So tech has been a big leader of growth in recent quarters, and that hasn't been the case in Q3.
All right, retailers have begun reporting now, and that is what kind of rounds out the reporting
That's
season. Trend-wise, anything standing out there?
I think we should see strong results from retailers. We do have a standalone sector for retail. Two parts of that sector, the restaurants and the online vendors, they have reported results already. It's the traditional brick and mortar operators that are reporting results now. Results in recent quarters from that space, which has been hit hard last few years, have been good. The domestic economy is doing very good. The consumer finances are in good shape and households are spending money. So I'm reasonably confident that we'll see another set of positive results both from the discounters as well as the department stores. And I believe they'll show positive trends in traffic and positive outlook for the holiday season. So I'm reasonably optimistic of good results from retail.
All right, let's talk about Q4 here. Let's look out to the final quarter of the year. There's talk out there of smaller than average analyst estimate cuts for Q4. What do you say?
Yeah, so estimates have come down. I have a slide to share with folks. So for Q4 18, the expectation now is of earnings growth of 13.8%. When the quarter started, it was close to 16%. So estimates have come down. Relative to the last few quarters, these are bigger cuts. But if we take a longer view over the last 4 or 5 years, these are modest and small. So estimates have come down, but not in a way that should make us worried about the near-term earnings outlook.
So will Q4 then bring smaller double-digit gains?
Yes. So we are on track, as we mentioned at the top of the segment, that 25.5% will be the earnings growth in Q3. In Q4, current expectation is for 13.8%. So typically, from the beginning of the earnings season through the end, we gain about 4 to 5 percentage points. So if that trend continues and the final growth expectation for Q4 is, say, 12.5 to 13%, then we'll get anywhere from 15 to 17% year-over-year growth in Q4.
So from that, can we infer that, and I've kind of mentioned this, we've talked about it a couple of times this earnings season. I'm going to come back to it again because the arrows seem to be pointing in the direction of corporate earnings reaching their peak. Starting now, a trend that's going to become more evident in 2019.
I think that's a fair point, and regular readers of the earnings trends reports and all other earnings commentary must be familiar with this chart. You could see that 2018, the big columns in this chart, Q1 was 24.7%, almost 25%. Q2, as I mentioned earlier, was an 8-year high at 25.4%, and we are on track to reach the same level in Q3. Q4, as we just mentioned, at best would be 17, 18, 19%. So in terms of the year-over-year growth, the peak has already been set. So it doesn't mean that earnings are declining. Earnings are still growing, but growing at a slower pace. So it's deceleration in growth, not earnings decline. So it's still a pretty strong earnings picture, just not as eye-poppingly strong and robust as it was in 2018 as a whole.
And all of that almost certainly going to have an impact on the stock market.
It should. It absolutely should. So as we get to the final part of the year, and as companies start pre-announcing and guiding their outlook for 2019 as a whole, that will have a big bearing on the stock market as a whole. Yeah.
All right. Well, we will probably check back with you at least one more time.
Sure.
Before the Q3 season wraps up totally.
Yep.
In the meantime, don't forget written commentary by Shiraz on our website, Zacks.com. Link to it off the homepage. Earnings previews on Monday and the written earnings outlook commentary on Thursdays or thereabouts. With Shiraz, I'm Terry Ruffalo.